My name is Kate Harmon, and I'm the Director of Cross-Campus Engagement for the Lundquist Center for Entrepreneurship. And today on our Getting Ahead series, I'm excited to have with us Bryan Wolf. Bryan, until very recently, was the Managing Director and Vice President for Intel Capital. Just stepped away from the company last year and is currently a board member and investor in multiple companies. So welcome, Bryan. I appreciate you joining us today.
Thanks for having me, and look forward to talking with you today.
Thank you. I'm excited to talk about you because of your background in corporate venture capital, which I know is a area of focus that a lot of our students are interested in getting into. So before we kind of go through some of the more laborious questions, if you will, can you give us a little bit of background about your entire career? Starting at UO, what was so fascinating is that you're a political science major who eventually went to Wharton and got an MBA. So I'm really interested to hear your kind of career trajectory and like what did you want to do back when you were an undergrad at UO?
That's a great question. So I grew up in Oregon, always had aspired to attend the University of Oregon. So attended from 81 to 85. And I'll be honest, at the time, I really didn't have a good perspective on what I wanted to do long term. But I did know, hey, I'll follow my passions and interests at this point, and knowing that I'd eventually go back to graduate school in some form or fashion. So during the University of Oregon, time at University of Oregon, as you said, I did major in political science with a minor in economics. And I got out, graduated in 85, and then I just tested a number of different paths for the next few years. So initially when I got out, I actually worked at a number of different radio stations for about a year and a half, both on the announcing side as well as the news reporting side, which was fun, interesting, but not a compelling career choice for me at the time. After that, I spent a year selling computers and photocopiers for a company locally in Eugene called National Photocopy. And then in between, I actually did utilize my political science degree. I worked a session at the Oregon legislature. First half of that session, I worked for a state senator on a number of different projects for him. And then for the second part of the session, I was able to work with a lobbyist who represented a number of different clients, one of them being the Oregon State Bar Association. So that was interesting, but as you know, the Oregon legislature, very condensed time. At the time, it was only in session for 4 months. So after that, I then joined a company called Progressive Insurance and was able to do a number of things for them for the next 2 years. And it was during that time that I really crystallized in my mind that I wanted to focus on the business side of companies and wanted to return to get my MBA. And so I was fortunate to be able to attend the Wharton School at the University of Pennsylvania. Graduated in 91 with a degree in corporate finance and public policy management. And joined Intel here in Oregon when I returned in 91. Originally in the finance organization, and they originally put me with a what I'll call an internal startup group at Intel that was focused on supporting small nascent business opportunities that they hoped would grow into some larger opportunities. And I was put with a group called the Server Business Unit. They were developing purpose-specific products for this new server market segment that Intel historically had not played in. And so for the next 5 to 6 years, I basically grew with that organization. We went from no revenue and no products to about $500 million in revenue and became fairly substantial for the corporation at that time. And then it was ultimately merged into another group. It was that experience that I had working with that internal startup that really catalyzed my interest in focusing on startups in some form or fashion. And so I looked at what paths at Intel I could pursue that would help align with that interest. And there was a nascent group at Intel called Corporate Business Development at the time that eventually grew into what is now known as Intel Capital, the venture arm. But it was only a handful of people. They were just starting out doing some small investments as well as some business development activities. So I was able to join that group, and for the next 2 decades, grew with them. I focused on the server and the data center space in terms of my investment activities. Eventually became managing director of vice president for the corporation. And then towards the last couple of years, I was asked to actually develop an investment committee for Intel Capital, which historically didn't really have an investment committee. It was a It was actually a more confined decision-making process at that point. And then I chaired that investment committee for the last couple of years. And then towards the end, I was asked if I wanted to go take over our European venture organization in Europe, which would have been fascinating, but at this point in my career, I want to spend more time in Oregon, not less. So I chose to step away from Intel after 28 years. And as you said at the front end, I now focus on my board work as well as consulting with various startups here in Oregon, and currently serve on 2 boards, one with a public company called Switch, which is based out of Las Vegas, a data center company, and then a private company out of California called Mirantis, which focuses on cloud software, in addition to my consulting activities with small startups.
Great, great. Well, I'm really curious, and I wanted to really focus this interview on your corporate venture background. For those in our audience that might not know what corporate venture capital is, can you give us a little bit of a brief overview of what that is?
Yeah, so corporate venture capital has evolved since I entered the business back in the 90s. But high level, it's really corporations investing in companies to achieve both financial returns as well as some kind of strategic return. And that strategic return can be measured in a number of different ways. Obviously, the financial return, it's pretty straightforward. It's IRR, it's cash on cash return. On the strategic side, once again, it depends upon what the corporation's trying to accomplish. At Intel, when I started, Intel was initially investing in what I would call supply chain companies, so companies that supplied into Intel's supply chain. Because Intel was such a large customer, you know, they had a kind of an asymmetric influence over those suppliers, and so they wanted to take a equity investment to both benefit from the upside that they were bringing to the companies financially, but also to influence their roadmap strategically. And so that was kind of the formation of Intel Capital at that time. As Intel then grew, into the later 90s and started to put out newer products with new capabilities and better performance, we also expanded our investment opportunities to invest in what I'll call complementary ecosystem investments. So complementary software and hardware technologies that really showcased what Intel's new products were doing. So there's this ecosystem out there already made when Intel introduced its new products that could then take advantage of those capabilities. And then over time, we evolved into what we internally termed eyes and ears capability, and that was Intel Capital became kind of the eyes and ears for the corporation on new technologies that were emerging in the broader ecosystem. And so we'd invest in some of those as a way of bringing back that information into the corporation. And then finally, we expanded geographically. And so we decided wherever Intel went geographically with its products and its manufacturing capability, we would also take our investment activities, once again, to develop more of what I'll call a geographical ecosystem around those products and capabilities. And so at the end, when I left, we'd invested over the time in some, 57 different countries. We deployed since '91 over $12 billion in over 1,500 companies. So Intel Capital became by far one of the largest corporate venture concerns by any measure you could make. But strategically, those were our objectives. And you could talk with any other corporation and they probably have some variation on those various themes.
So just to reinforce that your investment strategy was very much aligned to what Intel corporate strategy was.
By and large, absolutely. Occasionally, we would do some investments, what we call hedge investments. So if Intel had a critical product development on their roadmap, and we wanted to hedge our bets that if that didn't happen in the time frame we needed some other solution to take it, to fill the hole, we might go out and invest in something that would be competitive or a hedge in that regard. Otherwise, we'd also, if there's a new market segment that Intel was potentially interested in entering, we might do some lead investments in that market segment outside of what the strategy was at the time to get a feel for whether this would be a good area for Intel to enter down the road.
Makes sense. I'm curious, what kind of metrics did you use to determine what companies you would fund?
Well, once again, as an investor, we're focused both on financial return as well as strategic return. And you know, once again, financial return, very straightforward. IRR, cash on cash return. Are we making the money that we had committed to our shareholders at the time? Strategic return, once again, a bit more nebulous, right? And it really depended upon what your purpose was in terms of the investments. If in fact you were investing in a target technology that you could then use or incorporate in your roadmap that produced a certain amount of revenue, well, that's kind of an easy measure you can make. Otherwise, if you're doing all of these ecosystem investments I talked about, it's very difficult to say this one or these 5 ecosystem investments, you know, created this much specific value for an initiative. So in those cases, what we really did is we tended to go back to the general manager or the vice president of the business unit that those ecosystem investments were supporting, to get some kind of grading from them in terms of how important our investments were in furthering that larger initiative for he or she in that organization.
Gotcha. What stage of I don't know, of company lifespan were the companies that you invested in? Were they, you know, launched products already, you know, getting some traction, or were these the sort of stealth companies that might not have actually even launched? I'm just curious.
And the answer is yes, all of the above, right? Once again, it depends upon what we were trying to accomplish with those investments. If we're trying to address a near-term strategic gap in our roadmap or opportunity, then you really want to invest in a company that has products available in the market that you can immediately bring into your roadmap or ecosystem, right? So that's pretty straightforward, and that's a more mature company. In terms of those eyes and ears capabilities that I talked about, you know, kind of looking forward at those next generation technologies, it could run the gamut, but really you're looking at those early stage companies which may not have product for 2, 5, sometimes even longer years beyond that, right? So it really depends upon what you're trying to accomplish. And once again, we were focused on a lot of what I call ecosystem investments. And so there we look for a mix of mature companies that had capabilities already in market, and we look for those companies that are, you know, maybe 1 to 3 years away and are aligned with the entry of our products that we were going to make, so we could influence their roadmap a little bit in terms of really taking advantage of those capabilities that we were putting out in our products.
What was your process for sourcing deals? You know, how do you find that company in stealth mode? I'm curious in terms of how did you actually try to find these companies?
So very much, you know, consistent with traditional venture capitalists in that regard, right? It's a lot of cold calling, a lot of networking, a lot of conferences, a lot of feet on the street effort, right? In terms of really meeting with entrepreneurs, meeting with co-investors, meeting with other ecosystem players who understand what's going on out there, and really trying to get a lay of the land in that regard. So obviously, once again, you attend a lot of conferences, you're making a lot of phone calls, doing a lot of LinkedIn research and outreach to entrepreneurs or known entrepreneurs in the area. Social media more recently has become a big part of that, right? Social media allows a venture capitalist or a corporate venture capitalist to really communicate what our interests are, what our needs are, as well as help develop both a personal brand for the investor, as well as a brand for the company that we represent, because that becomes a big part of what entrepreneurs are looking for, right? It's not just the money, but what else can that person or that corporation bring to the table. So once again, those are, you know, traditional ways. Obviously, working for a company like Intel, we had unique insight into some emerging capabilities or technologies based upon Intel's presence in the industry, right? So we had over 100,000 employees around the world. Clearly, they had their hands in a lot of different areas, and were able to access maybe some companies early on that even traditional venture capitalists may not be aware of. And so that was both an advantage. It could also be a little bit of a hindrance, to be honest with you, because if an entrepreneur has had an experience with Intel that maybe was, you know, not as favorable as we had hoped previously, or they felt that Intel may be developing competitive products, then maybe they weren't so interested in engaging us. So working for that corporation and using the corporation as kind of a deal sourcing capability was a two-edged sword in that regard.
Interesting, interesting. I'm curious, for those companies that you ended up investing and potentially acquiring, how often would you end up keeping on a founding team? Was that common, uncommon? What kind of percentage might that be?
Well, here I differentiate between those companies that we were investing in as a minority equity investor, as well versus those companies that we were acquiring.
Mhm.
So when you're investing in a company, part of your thesis is the strength of the management team, the capabilities of the management team, and your assessment is, can this team make this company happen? So your difference is you want to support that company or those founders. You want them to be with the company, and you want them to grow with the company. So you can look back in history, whether it be at Intel, Robert Noyce, founder, and took the company public, very successful. Bill Gates at Microsoft, Jeff Bezos at Amazon, Reed Hastings at Netflix. Right, all founders, entrepreneurs who grow with their companies, made them very successful. Right, so that's your bent as an investor. Unfortunately, it doesn't always happen that way. So you may get into a situation where, either because of the interest of the entrepreneur or their capabilities, they're just unable to take it to the next level. And in those cases, some changes have to be made. And some, are easier decisions than others. Some of the more notable recent changes, in the ecosystem, the company called We, right, the co-working company. They had to replace their iconic founder, Adam Neumann, because he was just unable to take the company to the next level. Uber, Travis Kalanick, right? The founder took them just before IPO, but was unable to scale them beyond that into a successful public company. So had to make a change there. So changes have to be made for some reasons on the investment side, and you do make those changes. So that's on the equity side. On the acquisition side, it depends on what you're trying to acquire the company for. If you're trying to acquire a company that's creating a new product, division, or strategic capability for the company, then the founders and the team are a big part of that. So you want to bring them, they're part of the DNA that you then want to grow internally with your company. On the other side, if you're really acquiring a company just for a specific product line or a technology that you're fitting into an existing roadmap that you have, maybe the founding team isn't that important or as important, and by mutual agreement, you bring the product or technology on, but the team moves on after that. So it just depends upon your purpose.
How many potential deals would you see over a year? What would that sort of pipeline look like typically?
Well, once again, very consistent with what a traditional venture capitalist would see. So for every new deal we would do, we would see upwards of 100 different companies, right, at various stages. You don't look at them all the same depth, right, but you'd look at 100 companies to get to that one. So for Intel Capital, if we're doing 50 to 100 new deals a year, that's thousands of deals we're looking at a year across our global organization, right? So, the scale of that is phenomenal. The number of deals you see is phenomenal, but it is amazing the level of innovation out there. But once again, for every deal you do, you're probably looking at about 100.
And how many people are on your team, just to give a kind of perspective for the number of people, eyes on these deals?
Yeah, Intel Capital at the time, globally, we had about 75 investors worldwide. Most of them here in the United States, but once again, if we're doing deals in 57 different countries, some investors have responsibility across multiple geographies. So about 75 investors across the world. Once again, fairly large relative to the other corporate venture capital concerns out there.
Well, I know we have a lot of students interested in getting into this space, and they're always curious, like what would a typical day or typical week look like for you at Intel Capital?
Great question, because that's what I love. There was no typical day. There was no typical week. Most of the time that was good, sometimes not so good, depending upon the issues that arose. But that said, there's a number of different core activities, right, that we would do, right? We mentioned the deal sourcing, which obviously is the lifeblood of a venture organization. So you spend a lot of time, making cold calls, attending conferences, meeting with companies, right? You're trying to keep that pipeline moving forward in terms of that innovation that you're able to see. So that's a big part of it, meeting with those prospective companies. Clearly, we also had a big portfolio of existing investments. And that takes a lot of time in terms of managing that portfolio. You don't just put your money in and then on to the next. As they say at the store, you break it, you own it. In the investment world, if you invest in it, you own part of it. And so it's a big part of what you do as a venture capitalist is really manage that portfolio. It's either attending board meetings, you have regular meetings with management on various issues from the mundane of personnel to the more strategic of where's this company going, right? So big decisions there. You're trying to continue to work to align the portfolio company with in my case Intel and the strategic efforts that we're trying to accomplish there. Maybe you're helping them raise the next round of funding, right? So, they always need more money, or you're working with them on an exit opportunity. Either maybe they're being acquired by another company, or they're planning to go IPO. So there's a lot of portfolio activities there. For me, once again, I was also on the chairing the investment committee. So there's a lot of preparation involved in looking at the deals that are coming to the investment committee to making decisions there. We obviously have the big limited partner called Intel that we had to also work with to ensure that we were meeting the objectives there. So I'm meeting with a lot of internal people at Intel, just trying to align strategies, investment opportunities, and so forth. One thing that's really not talked about a lot, but is very important if you really want to be good at this, is a lot of your own independent individual research. These things, you don't just take the deals as they happen. A lot of it happens based upon what you know and how you come to know about it. And that's a lot of individual research. Some days I would try to set aside a day a week just to do independent reading, research, phone calls or one-on-ones with smart people to learn about new spaces, new opportunities, and so forth. And that's, once again, helps feed how you go focus on what you're trying to source from a deal perspective. And then finally, there's a lot of travel, okay? I was fortunate to live here in Oregon, but I never actually did an investment in Oregon for Intel Capital. All my investments were elsewhere in the country or the world. And so on a plane every week, there's a lot of travel involved in terms of being present with the deals that you're looking at.
What would you say would be some of your top 3 successes that you felt like you were able to achieve during your tenure there?
Yeah, I'll look at this kind of early and later, right? I mean, on the early side, I was fortunate to be placed in an emerging space in the industry, the data center and the enterprise space. There was a lot of disruption going on at the time. And once again, I'm talking late 90s, early 2000s. A lot of disruption going on in the space, so there's a lot of opportunity. So I made a lot of money early on for Intel in that space, investing in companies you wouldn't know about or understand today. Companies called one of them is called Itomi, which was actually a search engine before Google. Okay, so that's how far back that goes. So made a lot of money in the space then. More recently, in the data center space, a couple of companies to note. There's a company called VirtuStream. I was an early investor in. Dell Technologies acquired them to form the basis of their cloud business for in excess of $1 billion. There's a company I was an early investor in called Mellanox out of Israel. Today, literally today, they're about to finalize being acquired by a company called NVIDIA for about $6.5 billion, right? So very successful company there. And I currently serve on the board, as I said, of a company called Switch. I was an early investor in 2010. We took the company public in 2017, and today they're about a $4 to $5 billion concern. So, representative examples of kind of the core data center or enterprise successes that we had. Over time, I personally was involved in probably just over 150 investments and was able to work with my team to deploy just about $1 billion and we returned a lot of money to the corporation. So we felt good about that. We also had our share of failures, and failure is an option in the venture world. It absolutely is, and you need to be aware that you're going to fail on a lot of different companies. The best you can do is hope you learn from them and apply those learnings on future investment activities going forward. And if it balances, if you're able to do that, at the end of the day, hopefully you end up with a positive scorecard versus a negative scorecard.
Well, I'm curious then on the flip side, and you kind of already addressed with, having to travel a lot and stuff, but what would you say are the largest challenges in the corporate venture space?
Yeah, so once again, travel and just logistics of that is a key of it. I think the biggest challenge working in the corporate venture world is working with the corporation, okay, and trying to be the bridge between the corporation that you're investing on behalf of and the companies that you're investing into, right? Because there's a lot of orchestration that has to happen to bring those two together. As I mentioned earlier, in many cases, some of those companies that you want to invest in may have a little bit of hesitancy in terms of taking money from a company like Intel, either because they think it's going to be competitive, or they think, maybe they've had a poor experience working with Intel or a large corporation in the past. So there are potential issues there. On the Intel side, once again, as I said, it's a two-edged sword. It's great working for a company like Intel, 100,000 people plus, smartest people I've ever worked with in my life, I mean, by far. But they're so smart that they think they can do anything, including anything that a startup's doing that you're bringing to them, and you're trying to get them to support an investment in. So there's a lot of NIH, not invented here, right? It's like, well, of course we can do it better. And then there was others that would say, hold it, you want to invest $5 million in this startup? Why don't you give me half that money and I'll create that product even better here internally at Intel, right? So once again, there's a lot of that bridging that has to go on to one, make an entrepreneur company want or willing to take an investment from Intel, and on the Intel side, really getting the business unit prepared to accept that investment and work with them, because that can ultimately benefit what they're trying to accomplish strategically with the corporation.
I know people might be curious to know how you get your funding. Is it like an annual budget allocation that the Intel, the main company, gives to you all as the corporate venture arm every year? Does it fluctuate? Is it dependent on what investments are spilling off money? How is that sort of decided?
Yeah, you touched on a number of different good points there, which is, and once again, I'll take Intel as a representative example, because the various epics at Intel probably mirror what other corporations look at. Early when Intel was doing this, or kind of for the early part of it, the CEO of Intel would say, at the very least, be cash flow neutral to positive for me over a period of time, 2 to 3 years. So if you're going to, Intel Capital, if you're going to invest $1 billion over 2 years, make sure that your portfolio returns $1 billion or more to the corporation, so you're cash flow neutral, and strategically we're coming out ahead on that. If financially we're neutral, strategically we're ahead. So that worked. But it also depends upon who the CEO is. So when we had a CEO change, a new CEO came on board and said, I don't like that metric. I'm going to give you a fixed bucket of money every year, and you go invest that. And so when we got that fixed bucket, like I said, we had 75 investors across 50 some countries, multiple initiatives. It's very hard to parse out that money and say, we're going to do this much in this area and this much in that area within a given calendar year. So that became problematic. And we ultimately worked our way through that. And then finally, we came to some kind of accommodation as we got new leadership, which is we're giving kind of an annual guideline, let's say $500 million. And then if you're going to think you're going to exceed it or need to exceed it because you're doing different deals in a space that require it, heads up to the corporation, and let's just make sure we're doing the right things by the corporation, right? And so I think if you look at it, Most corporations have some variant of that. You'll see some announce funds for $100 million over 3 years. Those are pretty fixed, right, defined. But those are probably the exception. Most of them work off the balance sheet like Intel and have some kind of guidelines, which I just talked about.
What kind of trends have you been seeing or noticing in corporate venture over the last couple of years?
Yeah, it's been incredible. I mean, when I entered the business in the 90s, you could literally name individually the corporations that were investing. It was the big, large companies, Intel and IBM and Xerox at the time was actually a major company. But it was a very small group of large companies. Fast forward to today, since the Great Recession of 2008, there's just been an influx of companies and money into the space from corporates because they see the pace of innovation just rapidly increasing, and they can't internally keep up with it. And so they got to figure out how do they tap into the innovation that's going on in the ecosystem, and corporate venture becomes part of that. So today, like I said, in the 90s, when you can literally count on a couple of hands the number of companies involved, today there are over 2,000 corporations in the corporate venture world. And by last count that I saw from Global Corporate Venturing Institute, which is a trade organization that follows this, upwards of a third of all venture deals around the world have some kind of corporate venture investment included in them. So the scale and the participation is just tremendous by corporate venture capital companies. So that's the mega trend. I think, there are a couple other trends. One has gone global. So once again, going back to when I started, it was all US-based companies. Today, it's very global. You've got the Chinese companies like Alibaba, Tencent, Baidu, Huawei, participating in the ecosystem. You've got European companies, the car manufacturers, Daimler, Volkswagen, and so forth, Latin American companies. So, it's very global in scope in that regard. The diversity of industries are participating has also expanded. So once again, back in the 90s, it was kind of pure technology companies that were participating. Today, it's footwear and apparel, it's automotive, it's financial services, it's 7-Eleven has their own corporate venture. I mean, so the retail. So there's a lot of different industries that are represented in corporate VC that weren't 2 decades ago. And then I think, probably the third trend is similar to what's happening in the VC world. I think it came late to venture, but it's starting to pick up pace as you're seeing more diversity in the investment, in the investor class, right? So back in the 90s, it used to be, all people like me, right? I mean, white male and middle-aged. Today, we see an incredible diversity of people participating from female to minorities to otherwise. And that's been great because the perspectives that are brought to the table are just tremendous when you open up the diversity of participants in the ecosystem. And then finally, I would say the professionalism of CVC has really up-leveled over the past decade. It used to be that corporate venture was viewed as kind of, I would say, the equivalent of the kids' table at a restaurant, right? You corporates go over there, you put in your little dollars, and the traditional VCs would, we'll take care of it, right? Today, corporate venture is more likely to lead deals. They're more likely to take board seats, and they're more likely to be as influential, if not more influential, than the traditional VCs in a investment. So the professionalism and the sophistication of corporate VCs is up-leveled dramatically over the past decade plus as well.
Well, my final question then for you, kind of wrap this all up, for a student interested in going into the corporate venture capital space, what kind of recommendations do you have them think about at this point in terms of should they be studying or developing skill sets, or what kind of entry level jobs should they be seeking to sort of really get a foot into this space?
Well, I'm going to key on that last comment which you made about entry level early opportunities. You cannot underestimate the value of having an operational background that you bring to bear as a venture capitalist, right? If you don't have that operational background or that experience, so once again, I had, about a decade of operational experience in various industries, various capacities. If you don't have that, it's very difficult for you to gain the trust of the entrepreneur. Once again, there's a ton of money out there, and the entrepreneur has their choice of money. So then they look at what are the other qualities of the investor that investor is bringing to the table. If you have no relevant experience or background or perspective to bring based upon your own travels in the industry, it's very difficult to really sell the entrepreneur that you're the right investor for them or the right board member for them. Vice versa, it's also very difficult for you to call BS on them, because they're flipping a bunch of foils or tell you how great they are, how great their company is. But if you, once again, if you never lived with a sales force, if you've never, dealt with manufacturing issues or what have you, right? Then how are you supposed to be a check on what that entrepreneur is telling you in terms of selling you on an investment opportunity? So operational background is, I think, very important, and it could be in many different disciplines, or it could be one deep dive into a discipline. But bringing some level of operational background, I think, is important. In terms of just other, what I'll call skill sets, obviously business and financial acumen are key, right? I mean, you're looking at not just financials, but you're negotiating deals, you're looking at cap tables. So there's a lot of acumen that comes with that. We talked about networking, the ability to network. People say, it's easy, I can go meet people. It's not that easy. It's not that easy to develop a network, a valuable network, and one that's iterative, right? And the one thing that people fail to grok early on is that it's not just a take, you got to give in a network, right? So it's great that you're getting information from people, but if you're not giving something of value back, a one-way network never works. Okay, so you've got to have skill sets and capabilities to add to that network as well to make it a very vibrant and viable network in that regard. Program management skill sets are important. A deal involves both an external company, your own internal company. It involves attorneys on both sides. It involves engineers. It involves supply chain people. It's about finance and treasury. I mean, there's a lot of people and a lot of organizations that you're orchestrating. And by the way, if you as the investor are not orchestrating them, it doesn't happen. So program management capabilities, ability to manage projects is an important, just core skill set in that regard. And then finally, communication, both verbal and written, okay? Because you are communicating a story. You're trying to sell a story, both, like I said, written and verbally, both to an entrepreneur, to your business unit, to an investment committee, to a prospective customer, right? And so the ability to communicate and really influence through communication is important in that regard. So those are some core skill sets. I would also say that there's probably some qualities that are very important as well, and those include integrity. Integrity is job one in this business, right? An entrepreneur is entrusting you with their core assets, information about their assets, right? A corporation like Intel is entrusting you with shareholder money. I mean, there is no bigger responsibility from a business perspective than those two obligations. So integrity is very important. Discipline in terms of just being able, once again, to move things through the process. And there's a lot of noise in the channel and the ecosystem as you try to get a deal done. Just being very disciplined and focused in that regard is important. Being pragmatic. You cannot be, just locked into your own perspective on things. As I learned early on, my perspective on a deal isn't necessarily what the broader perspective is or could be, right? So you really have to be pragmatic in how you look at opportunities and not just be sold on a deal based upon your perspective or dismissive of a deal based upon your perspective. A natural curiosity is important. You've got to always be asking questions, why? Why do we need this, or why doesn't this exist today, and why should it exist, right? I mean, you just have to be curious and always asking questions because that's where the new stuff comes from, right? And that's how you uncover the new stuff. And then I mentioned early on, all the research and so forth. A learning mindset An ongoing learning mindset is important. You are learning every day in this job. And if you aren't learning, then you aren't really doing justice to what this job requires, which is trying to understand the ecosystem, learn new things. Like I said, ask those questions that maybe sound stupid, but are important in terms of uncovering what those opportunities are down the road. So I would say those are a core set of qualities that are also important in this job.
Well, that's great advice. I really appreciate it. Appreciate you sharing your story, giving us an overview of corporate venture capital. Bryan Wolf is a former vice president and managing director at Intel Capital. Thank you, Bryan, for joining us today.
My pleasure. Thank you.